Hey everyone, so we're into our third video here. We've discussed the first two in our previous videos. Go check them out. Just provide any feedback, good or bad. The next one is calls versus puts. So I want to show you um, like how the long side and the short side differs. So what's a long call? Obviously, I think I've shown you long calls and long puts, but now let's go through actually hitting the confirm and send button and actually trying to buy it. Okay. So we are first trying to buy a long call. I don't know why I keep going to this 220 strike. It's just like I normally trade round numbers. So you can also see the open interest here on the rounded numbers. So always make sure that you look at these things. There is a 25,000 open interest in the 220 strike versus 72 in the other one. So I would not waste my time trading a half number strike. You see this? And that's why it's important to keep volume and open interest there, always in your view. You can go down the list and just keep going and checking. Like, look at this: 232.5 has 701 versus the one above it, 230 has 40,000. So always trade the higher liquidity strike. Do not go into these half funds, and therefore that's why I'm going. Even though this option is cheaper, 660, you will end up paying a lot more. Um, because there's not liquidity. There's no liquidity there. If the market drops, these spreads will widen out. Anyway, next one. So let's go ahead and try and hit the confirm and send button, and then actually try and buy it. Long call, long put, and then I'll show you short call, short put as well. So very very quickly, if you are trying to buy a call option, always hit the ask side. So ask means you are taking the whatever the seller is asking for, you are taking that price. Um, and you're buying it at that price. Now, when you sell out of this option, when you have to close this, you will sell it at the bid. So at that point, you will hit this side of it. But you don't need to, because when you try to close the option, the platform does it for you. But we will do both of those sides right now. So ask is we go out here. Always make sure that your number of contracts are set to the minimum risk or the maximum risk you can take on each contract. Do not blow up your account by going 5 or 10 contracts. I don't do that, especially on the buy side. We don't do that. I stick at one, maximum two, depending on whatever the size is. Now let's just analyze the trade. We know we've gone through these numbers already. We're collecting 68 delta. So meaning when the stock goes up by one, my position, the price of this delta of this call option will go up by 0.68, meaning 68 cents it will go up by. That's how you need to look at it. Don't think that this thing will go up by $68. This thing will not convert into $68 or something, or $74 or whatever. It will not. And then you're losing $11 on theta every day. You are gaining $20 on volatility, meaning if vol goes up, if the market goes down, if the market goes down, the vol goes up. When that happens, you make money because you're a positive vega. The worst thing about these long options is that it gives you this negative theta. So every day that you hold this, contract, it gives you negative theta, meaning you lose this on a daily basis. Okay, now let's confirm and send this. Let's do this. So and then this is the market order. I'm taking the market price at 25. If you want to buy it cheaper, lower this price. If you want to, if you're willing to take the market price, just remove this lock sign and then go in with the market. The limit, now this has become a limit price. When you change the market price, it now has become a limit price. When you buy options, when you buy something you want to buy cheaper, when you sell out of it, you want to sell at a higher price. So, okay, right click, confirm and send. I'm going in with my limit price, right? So that's why this thing comes up as limit. I think if you take the market price, it comes up as market. Let's see, maybe not. It still shows as limit, but yeah, that's the limit. It will try and find you the best price at that point. Anyway, one contract going in, send. It didn't hit. It did, so I got it. So here's the mark price. Now this is what I will look at. This is the line I'm looking at. I was trading a covered call strategy before this, so that's why we have these closed positions. Made some money on it though, but as PNL open, PNL days down a little bit, but 23 days left, right? I got a price of 825. This is the mark price, which is 825. This mark change will tell you how much the options price, which the underlying has changed today. This is the underlying price. So go back to, actually this is not, this mark change is not updating. This is the options price. That should change, but it's not changing. In my real account, I have a couple other metrics that I look at. So trade price mark as a percentage. That's the one I have. So let's bring that in. Percentage change. This one. Yeah. So it's down by 109. Yeah, this is the stock price, which is down by 110. I'm not sure why this 150 is not changing. This 249 is fine. This is the stock change price. Okay, this is the option price. So, okay, this is how you should read it. So this options, if you look at the day over day, if you look at the price of this option, overall has changed by $1.47, and you can get that info here. If you bring in, let me customize this. So if you bring in mark change or something, mark, let's see, yeah. Okay, so what is the mark showing us? Is there a mark here? What is the mark? 8275, okay. So this is what the number is. So 8275. Now there was something else that would show the percentage change in the price of this option today. I'm trying to find that one. Mark change. Anyway, let's type change in there. Net change, yeah, maybe net change. Let's see. There you go. Negative 190. That's the one. Now let's look at your monitor tab. Negative 150. That doesn't work. This thing is not updating here, this 150. Because the net change in this option price has been 190. Anyway, we don't really need to focus on this, but just wanted to show you how to look at it. All these options are down today because the stock is down, right? So you can see the stock is down $2.50, but the options price is down by 190. So this is the leverage effect in these options. Quickly, we're running out of time. So that's the price that we got in at. Right click and then sell. So I bought it at 825. I'm going to sell it at 830, and you can just select your price and then sell out of it. So you would get charged 65 cents again. So 65 cents to get in, 65 cents to get out. That's how you buy and sell. Same thing on the put side. Just go on the ask side if you want to buy puts. Go down to 1. Always analyze the position. Now this has become a long straddle because we have a long call and a long put. So that becomes a long straddle. Anyway, we don't need to discuss that right now because we're going to do that later. Long put, again, same methodology. So if you want to go in, just right click, confirm and send. And then always make sure you're paying 765. You know the exact buying power effect. It's important to know all these numbers because otherwise you'll be, completely confused at where my money is going. Why am I down so much when the stock is up and everything? So it's probably going to your commissions. Anyway, I'll see you in the next one. Thank you. Bye-bye.